Hi guys, so we're going to be doing handout 4, overs and unders. It's a big one. So before we start with the problems, I kind of want to just go over the idea of what we're doing, the concept of it. So we're looking at errors or omissions that this company Alpha made throughout the year, and we're seeing whether this error or omission understated, overstated, or no effect happened to specific accounts. So in each problem, we'll be looking at if this error or omission affected our total assets. We'll see if it affected our total liabilities, and then we'll also see if it affected our net income. So with total assets, if any of these problems have to do with like cash or AR, maybe something would happen to total assets. Total liabilities, maybe something like accounts payable or unearned service revenue. And then for net income, maybe something will affect it like revenue or expenses. So it's not really the accounting equation. We're only looking at part of the equity. So we're doing assets, liabilities, and then just net income. So revenue and expenses. Just a note, revenue increases our net income and expenses decrease our net income. Okay, so let's get started. So this first one is just an example, not number one, so we'll be looking at this one. So we failed to record a cash sale. So I'm going to be doing this with some different techniques, whichever one works best for you. So I'll be doing some journal entries and then we'll go from there. So if they failed to record a cash sale, they should have debited, let's see, they should have debited cash and credited sales, but they didn't do this. Now we're going to look at each account and see which of these they might affect. Cash is an asset, so we're going to label this with an A. And when you debit cash, it increases your assets. And for sales, that's a revenue. When you credit your revenues, they increase your net income. So we're going to put an NI here, and we're going to put an up arrow because it also increases. So if we didn't do this, then our assets are going to be understated because it should have been increased by this debit to cash, but it never was. And now looking here for our liabilities, neither of these accounts are labeled with an L. Neither of them affect our liabilities. And so we're going to put an N here. There was no effect on our liabilities in this problem. Now for sales, it should have increased our net income. And if it was never increased, then our net income is also going to be understated. So that's our answer, U, N, U. We can check our work right here, U, N, U. Okay, moving on to number 1. The purchase of equipment for cash is recorded as a debit to equipment and a credit to accounts payable. So let's write down what they did in red, and then we'll write down what they should have done in blue. So they debited equipment and they credited accounts payable. But here they say it was a purchase of equipment for cash. Cash, they paid cash. So the issue here is that they should have, so the debit to equipment was correct, but they should have done a credit to cash because they paid it, right? They didn't need to increase their liability because they paid cash for it. So they should have done a credit to cash. So looking here, we can check this off because the debit to equipment was correct, right? But when they increased their accounts payable, when they credited their accounts payable, that increased their liability. And with cash, they did not credit their cash, which would lower our assets, right? So now let's see what our answer would be. Assets, we see that cash affects our assets and it should have been lowered but it was not. So our assets are going to be overstated. Should have been lowered, so it's higher than it should be right now. Now for liabilities, our liability was increased when it should not have been. So our liabilities are also overstated. And none of these accounts affect our net income. So it's going to be no effect on our net income. So we have O, O, N. All right, moving on to number 2. Failed to record the purchase of merchandise, which is inventory, on account. So they just failed to record this transaction. So let's see what the transaction would be. They bought it on account, so we didn't pay cash for it yet. So since they're saying it was a purchase, we're going to debit our purchases, and we're going to credit our accounts payable. And let me note here that we are going to assume that they use a periodic inventory, which is why I used purchases and not inventory as the debit. So here we have purchases and we have accounts payable. So which accounts do they affect, right? Purchases is an expense, and our expenses affect our net income. When you have an expense, it lowers your net income, and expenses have a normal debit balance, so this would also lower our net income. Accounts payable should have been credited, and that increases our liability. Okay, so these were never done. So let's think about our answer now. Neither of these accounts affect our assets, so it would be N for our assets, no effect on our assets. Now for liabilities, our liabilities should have been increased, but they never were. So our liabilities are going to be understated. Now for our net income should have been lowered, but it was not lowered. This expense would have lowered our net income. So our net income is overstated. So it's N-U-O. All right, moving on to number 3. Cash received from a customer in payment of its existing account is recorded as if the receipt were for a current period sale. So they recorded it as if it was a current period sale, but in reality, they were just getting paid for an existing account a customer already had. So let's talk about what they did, and then we'll do what they should have done. So what they did was they recorded it as a current period sale, which means they debited cash and they credited sales. But what they should have done is they should have debited the cash, and that was correct because they got cash, but the account was already existent for that customer. So that customer in Alpha's books had an AR account. And now that they've paid them, they don't need to have that account anymore. So we're going to credit that AR account. So this is what they did, but this is what they should have done. So we're going to check off this cash because the debit to cash was correct. So we don't really have to worry about that. But let's see how these accounts affect our answer. So sales, a credit to sales increases our revenue, and an increase on our revenue is an increase on our net income. Okay. And a credit to an AR account, AR is an asset. And so if we credit an asset, it's going to lower our assets. So now looking at our answer, assets should have been decreased, but they weren't. So our assets are going to be overstated. Nothing happens to our liabilities. Neither of these accounts affect our liabilities. So there's going to be no effect on our liabilities. Now for sales, or for net income, our net income was increased, but it should not have been. We put this in red. They should not have increased their sales. And so net income was increased because of that, which means our net income is overstated. So we have O, N, O. All right, number 4, recorded a credit sale as a debit to cash and a credit to sales. So what they did was they debited cash and then credited sales. What they should have done, because it was a credit sale, they never got the money for it, or they haven't gotten the money for it yet. So they should have increased their AR account and credit their sales. So let's check off the sales because that was correct. And let's look at these two accounts. A debit to cash increases our assets, right? And a debit to AR also increases our assets. So in this case, we're looking at, I'll show you here. We're looking at our total assets, our total liabilities, and our net income. We're not really looking at each account like we were in Handout 1 and moving it from one account to another. In this case, even though it was put into the wrong account, our assets were increased in the correct way. Our total assets were increased. So because this problem only affects our assets, kind of, not really, we're going to put no effect on any of these accounts. All right, so number 5, the receipt of money from a bank loan is recorded as a debit to cash and a credit to sales. So what they did was they debited cash and they credited sales, but they got money from the bank for a loan, right? What they should have done is they should have debited cash and they should have credited loans payable. So the debit to cash was correct. So we can mark it off. We don't need to worry about that. But the credit was incorrect. So our sales are revenues and they increase our net income. So we're going to put an NI with an up arrow. But our loans payables, that's a liability, right? We owe the bank back that money when the loan is done. So a credit to a liability account will increase it. So now let's think about our answer. Neither of these accounts affect our assets, so there's no effect on our assets. Now with liabilities, our liabilities should have been increased, but they weren't. So our liabilities are going to be understated. And now for our net income, our sales increased our net income, and our net income was increased when it shouldn't have been. So our net income is going to be overstated. So we have N, U, O. All right, number 6, failed to record depreciation at the end of a current period. So what is the journal entry for depreciation, right? So it would have been a debit to depreciation expense and a credit to accumulated depreciation. Now let's see which accounts these affect. Depreciation expense is an expense, so that's going to lower our net income. Now, accumulated depreciation is a bit of a tricky one. It is a contra asset. So if all assets have a normal debit balance, then accumulated depreciation is going to have a normal credit balance. And accumulated depreciation lowers our assets. So all of our debits to regular assets increase them, and all of our normal, well, this would be the only one, but I didn't like that explanation. I'm going to start this one over. I didn't like that one. Okay. All right, number 6, failed to record depreciation at the end of the current period. So they failed to record a depreciation, which means they did not debit depreciation expense. And they did not credit accumulated depreciation. So depreciation expense lowers our net income because it's an expense. And now accumulated depreciation is a bit of a tricky one. It's a contra asset. And so it has a normal credit balance. Accumulated depreciation lowers the value of our assets. And so this is going to be an asset that should have been lowered. So now looking at our answer, accumulated depreciation would have lowered our assets. And if our assets were never lowered, then our assets are overstated. Neither of these accounts affect our liabilities, so there's no effect on our liabilities. And now depreciation expense was never recorded, which would have lowered our net income. And so our net income is also going to be overstated. Number 7, failed to record adjusting journal entry. Salaries are paid every Friday for a 5-day work week. The normal weekly payroll is $40,000. The year end falls on a Tuesday this year. So they're not ready to pay cash for these salaries, but because the year end falls on a Tuesday, they want to record the expense of the salary of those 2 days, but they're not ready to pay it until Friday. So this is what the adjusting journal entry is going to be. They're going to debit salaries expense, but since they're not ready to pay it yet, they're going to create a liability for it. So they're going to credit salaries payable. So another expense, which is going to lower our net income, and a payable account, a liability that was created, should have increased our liabilities. So now neither of these accounts affect our assets, so there's going to be no effect on our assets. Now for our liabilities should have been increased, but they never were. So our liabilities are going to be understated. Now for salaries expense for net income, our net income was never lowered. So it's higher than it should be right now, which means our net income is overstated. All right, number 8, failed to record adjusting journal entry. Examining the rent expense account, the controller finds that it includes a $4,800 advance payment for 3 months' rent. The payment was made on November 1st. So they were looking at this rent expense account. They expensed all of their rent in the beginning on November 1st, and that was 3 months worth of rent. But on December 31st, because we're doing an adjusting journal entry now, only 2 months have actually been used. So what we have to do is we have to unexpense one of those months and put it into prepaid rent. So our journal entry for this adjustment is going to be a debit to prepaid rent and a credit to rent expense. Okay. Prepaid rent is an asset, and a debit to an asset increases it. Now, rent expense, we usually debit our expenses, right? But in this case, we're unexpensing. So it's still going to affect our net income. But since we're crediting an expense, we're making our expenses less. So they're going to increase our net income. They're going to bring our net income back up. Instead of having $5,000, instead of having $4,800 of expenses, we're only going to have $3,200. So it's not going to lower our income as much. So this was never recorded. So for assets, they should have been increased, but they were not, right? So our assets are understated. Nothing happens to our liabilities. Neither of these accounts affect our liabilities, so there's going to be no effect on our liabilities. And for rent expense, should have increased our net income, but that was never recorded. So our net income is going to be understated. Our net income was too low. We had too much of an expense in our net income. All right, number 9. Failed to record adjusting journal entry. There's $500 of supplies left in the storeroom. At the beginning of the year, there were no office supplies. During the year, $3,500 of office supplies was purchased. So we have a beginning balance of 0, and we have purchases of $3,500. But at the end of the year, we only had $500 worth in the storeroom. So that means we had used the difference. We had used $3,000 worth of supplies during the year. So we have to expense that. So the journal entry for that is going to be a debit to supplies expense and a credit to supplies. Once again, a debit to an expense is going to lower our net income, and supplies are an asset, but we're crediting our asset. So that's also going to lower our assets. So this was never recorded. So let's see for assets. Assets should have been lowered, but they weren't. So our assets are going to be overstated. Nothing happens to our liabilities. Neither of these accounts affect our liabilities. So there's going to be no effect on our liabilities. Now for net income, our net income should have been lowered, but it wasn't. So our net income is going to be overstated. All right, number 10, failed to record adjusting journal entry. The company received an order in May with a $13,000 advance payment, which was credited to unearned revenue. In November, the last of the order was shipped to the customer. So in November, well, when they got the money in May, they put it all into unearned revenue, which means they haven't recorded any of it as revenue yet. But in November, they shipped the last of that order, which means they fulfilled their duty and now it has been earned. So we need to take it out of unearned revenue and put it into revenue. So the adjusting entry for that is going to be a debit to unearned revenue and a credit to revenue. So unearned revenue is a liability account, and a debit to a liability lowers it. And our revenue account is going to affect net income, and a credit to that is going to increase our net income. So no assets are affected in this problem, so there's going to be no effect on our assets. Now for liabilities, they should have been decreased, but they weren't. So our liabilities are going to be overstated. Now for revenue, it should have been increased, but it wasn't. So our net income is going to be understated. All right, number 11, failed to record adjusting journal entry. The company has a $20,000 9-month 12% note payable outstanding at the end of the year. The note was issued on October 1st. Interest is to be paid when the note is paid. So the adjusting journal entry that we have to do for this is to accrue the expense that we have to pay when we pay back the note. So that is going to be a debit to interest expense, but we're not paying it back yet. So it's going to be a credit to interest payable. So expenses decrease our net income, and a credit to a payable is going to increase our liabilities. So nothing happens to our assets. Neither of these accounts affect our assets. So it's going to be no effect on our assets. Our liabilities should have been increased, but they were not. So our liabilities are going to be understated. And our net income should have been decreased by this expense, but it was not. So our net income is going to be overstated.